Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Well, the Federal Reserve held its benchmark Fed funds rate steady in a range between 5.25% to 5.5%. The decision was unanimous. Officials also maintained their outlook for 3 25 basis point cuts this year. After the decision, Chair Jay Powell said that the Fed would require more evidence of a retreat in inflation.
The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response.
So that, again, is 3 rate cuts this year. But for 2025, the Fed is now forecasting just 3 rate cuts instead of the previous forecast of 4. Joining us now to shed some light on all of this is Lydia Boussour, who's a senior economist at EY, to talk a little bit more in detail here on the Fed. Lydia, I heard someone say the other day that Jay Powell has this uncanny ability to not create any news. And I think today was probably an example. It's steady as she goes sort of thing. But I think we can say that one of the points that Powell made effectively, I think, was that, look, the Fed did not overreact to the 7 months of quick disinflation last year. And it's not overreacting now to the slightly hot 2 months, January and February, of hot inflation data this year. It's not so easy to poke holes in that, is it?
Yeah, so that's right. What we saw today is, I think, a Fed that really stayed the course, and really, the Fed's narrative hasn't really changed. The Fed is expecting inflation to continue to move lower, and is still believing that, sometime this year, they'll be, in a position to start lowering interest rates. But as you said, they want to gain greater confidence that inflation is moving sustainably towards 2%, and that means we need more good inflation data in the coming months to start that easing process. In our view, we think that, they're likely to be in that position in June, in the middle of the year. We think that by June, they can start the easing process. And we do expect to see, 3 rate cuts later this year.
Is it possible that we're living in a world where the Fed will tolerate inflation just above that 2% target?
Yeah, there is, there are some factors in the economy, in this post-pandemic economy, that are pointing to, some inflation staying somewhat, higher than the inflation target. We've seen some structural changes in the economy. There are also, demographic changes, the energy transition, to cite a few, and the slowdown in globalization. And all of these factors do suggest that, inflation could be hovering slightly above the 2% target. Now, the Fed is still committed to bring inflation back to target. And I think what was even, more important in the new set of economic projections on the dot plot is the fact that the Fed is now, I think, really embracing this idea that we can continue to see sustained economic growth with inflation coming back lower, thanks to favorable supply-side conditions, which have normalized significantly, but also a pickup in productivity growth.
Yeah, I think we can argue that the Fed can afford to be patient. Inflation now is well below the Fed's benchmark rate. I mean, by a long shot. It's somewhere around the high 3s at the moment, and the benchmark rate is 5.5%. Unemployment is near record lows, and inflation is below wage increases. So if you ask people, I mean, they're not jumping up and down. They're still complaining about inflation, but the math is working for them.
Yeah, I think what was really important is the fact that, as you said, they're willing to look through the noise in the inflation data at the beginning of the year, and they did not overreact to these upside surprise in inflation. But if you take a step back and look at the broad inflation trend, we continue to think that, we remain in a disinflationary environment. And I think that's what the Fed is also looking at. we have seen a significant rebalancing in labor market conditions and also a slowdown in wage growth. When we look at pricing power, companies have certainly seen a decrease in their pricing power and shrinking in profit margins as well. And then when we look at some of the key inflation drivers, such as shelter inflation, we're also expecting to see more disinflation there. So I do think that as we move throughout the year, you're going to continue to see that broad disinflation trend playing out. And I think that this is really going to be allowing the Fed to start easing and to start the easing cycle.
When we look at the macro environment, so often the calculations are based on cold, hard facts. And I'm wondering if there's an affect here that we can maybe, believe in, which is to say that maybe this Fed is poised to cut. It would very much like to cut. Is that the feeling that you get?
There is this feeling coming out of this meeting that the Fed wants to cut whenever it will be appropriate to do so and whenever it can do so. And I think, just looking at the inflation prints, they're going to be looking at the inflation data very closely. We're going to get, more data points. But I think that, if we see that that cool down in those inflation prints, the Fed is going to be willing to start, that easing process. And it's really about balancing the risk between keeping rates too high for too long. And I think the Fed doesn't want to be imposing unnecessary pain to the economy. So they're really cognizant of the fact that, that the labor market could soften significantly. And Fed Chair Powell did mention that as potentially triggering more rate cuts.
Yeah, but I thought, as an investor, as somebody who covers this, I thought he sounded pretty much not all that concerned about the labor market, even though, he was given some examples about where you're seeing pockets of weakness, and he was pretty comfortable with what's happening there.
Yeah, the labor market has been, you continue to see solid job growth. We continue to see solid job growth, but at the same time, the supply side of the labor market has been rebounding. We've seen the labor force participation rate, especially for prime age workers, rebounding and reaching the highest level since the early 2000s. So you've got that rebalancing with job openings coming down, labor demand coming down, and labor supply coming back up. And at the same time, the unemployment rate hasn't really moved up significantly. And that's why I think, the Fed right now is not that concerned. What they're, I think, welcoming is the fact that this rebalancing is leading to an easing in wage pressures. And that's the type of dynamic that they want to see, to see more disinflation, especially on the services side of the economy.
Lydia, in the time that we have left with you, I'd like to get your take on what happened this week with the Bank of Japan. What is your view here on what the BOJ did and the way in which markets are responding?
Yeah, we saw that the BOJ, exiting negative rates and moving away from that very accommodative stance. And I think, if you look at the market reaction and the move, I think part of it is, the fact that this was maybe a bit more symbolic, than really the signal that we are heading into a tightening cycle. I think economic conditions in Japan remain quite fragile, and the BOJ really wants to see that anchoring in inflation expectations. So they're not going to be embarking on an aggressive tightening cycle. I think they're going to be willing to kind of keep some accommodation and monetary policy, financial conditions essentially loosed, so that the economy can continue to recover.
So on Monday, we were sort of musing this week. What would be the big event this week? Would it be the Fed? Would it be the BOJ or NVIDIA's developer conference? From your standpoint as a senior economist, what was it?
Yeah, it was. We've got a bit of. From an economic standpoint, I think the BOJ and the Fed and what we heard, from the central banks is important. And I think there was a lot of attention today on the dot plot and whether the Fed could be signaling only 2 rate cuts instead of 3. It was a close call. We were one dot away from getting 50 basis points of rate cut from that median dot plot. But overall, I think that, it was encouraging to hear that the Fed is staying the course and that it's still willing to cut interest rates and looking through that noise in the inflation data.
Yeah, I remember asking almost every guest on the show yesterday. It seems like the market is okay with what we've seen in inflation, a little pickup in January, February. The key question for the Fed will be, is the Fed okay with it? And I think they answered that question today, that at least for now, they're okay with it. Lydia, thank you for joining us. Lydia Boussour, a senior economist at EY. This is Bloomberg. Oriano Lizza joins us, CMC Markets Sales Trader. So what, this is as good as it gets? Come on.
Good morning, gentlemen. Thanks for having me. It was a bit of a, nothing burger overnight. And I think the market was expecting a little more, even though there was a pop in equity markets. That dot plot revision was pretty much cast aside, I think. And really the main focus is on those macro indicators. So, they do still have somewhat of a balancing act. I do commend the Fed in the way they've navigated, around, obviously, trying to increase, growth, but obviously maintain the market, and obviously the dollar remaining stronger. So pretty positive all round. I think we are higher for longer, looking at some of those forecasted GDP and also inflation figures. So not too much to report. The dot plot remains in, fairly steady in terms of its projections. It would be interesting to see a surprise and see how the markets react.
Yeah, Powell's tone seemed kind of dovish, and I'm wondering whether or not the market may be overlooking a risk. I know what the Fed is saying now. Yeah, we're expecting 3 rate cuts this year, but is it possible that we only get 2 25 basis point cuts?
That was something that was, I think, prior to the meeting was discussed, and I don't think it's completely out, completely, not an issue. I think the inflation rate is still fairly manageable, so I can't really see it being pushed, sort of cut back at all. If we were to see 2, I guess the question remains: do they look to accelerate in 2025? Should inflation tail off as sort of expected? No is probably my initial, sort of gut feeling, gentlemen. But let's see how this plays out.
Yeah, markets are so buoyant. We continue to keep discounting. Well, we've got a soft landing and things are looking pretty good. You'd think that you'd get an adjustment in that, and then you'd need some really big news, or to generate these kinds of gains. I mean, some of these gains are pretty astronomical now, and I wonder whether or not Oriano Lizza thinks that perhaps we're getting overheated.
Yeah, that is a major concern for me, and something I've spoken about previously on other discussions. I think we are getting a little bit toppy at the moment in terms of some of those markets. My major concern, gents, is that the lack of breadth of market is probably maybe more of a factor. We're so concentrated in the so-called Magnificent Seven stocks that if we do see any sort of sell-off, can the broader market sort of prop up or sustain that continued growth? Naturally, profit taking will take place within some of the institutions where those fund flows then go to, with obviously bond yields coming off a little bit, and those risk-free returns not as handsome as they have been in previously. But I do think we need maybe a somewhat slight correction in terms of price action.
So if you were looking at opportunities right now, I mean, not a trading opportunity, something that would have to be buy and hold, let's say, for the foreseeable future, what would it be?
Well, I'm leaving Bitcoin out of this, gents, as though it's the hot topic of the time. But let's go away from the obvious. I am looking at the moment in terms of a couple of market conviction calls, some smaller cap stocks, both in the UK and also in the US. I think that variance in terms of the sort of variance in terms of valuations between those big cap and small cap stocks. So looking at some stocks in the Russell and obviously some in the lower cap indexes in the UK of value. You need to be selective, though, in terms of the specific stocks that you are looking at, because some are priced, for a reason at the lower end of the market. So in terms of, sector, I'll be looking at those smaller cap indexes for value.
So let's talk a little bit about Japan, because we had a major change there. I wouldn't describe what the Fed did was a major change, but it did seem like an inflection point, whether or not they would be acknowledging that inflation was hot in the first part of the year and something needed to be done about it. That's not the decision they took. But in Japan, we did see a well-telegraphed move, and then we got the move. And outside of the equity market, it was a bit of a yawn.
That seems to be the rhetoric across all markets in terms of macro announcements this week, where we were expecting a little bit more, from price action. Yeah, obviously, naturally, was very much priced in terms of the two, I guess, major markets, obviously being the Nikkei, which has hit an all-time high this morning, and obviously that dollar yen, which has been a hot topic of discussion. Not much sort of volatility in those two, very much baked into the price. I do think it was a historical move by the Bank of Japan, but not so much impactful one. So in terms of them rising rates further to sort of tackle maybe inflation, it is something that may be considered later in the year. I think some of the debt servicing that the BOJ needs to look at from their own balance sheet perspective will probably come into focus. And in terms of quantitative easing measures in terms of bond buybacks, which they mentioned they might still be interested in, is going to take a long time for them to get back to normalization, which is the talk of the town.
So if you had to take a position on the equity side in Japan right now, would it be in the banks, or do you think that trade is pretty much played out?
I think the price action reflected quite sort of aggressively where the banks dropped off. Obviously, they went to that higher interest rate. Those banks will be looking at, some of their underwriting mechanics to see, what sort of exposures that they do have to, outstanding debt. I think that we'll probably have to move away from the banks, similar to the US. Take a look into some sort of the tech stocks within the Nikkei. But yeah, banks might be a sort of tread with caution play at the moment, given the rising interest rate environment.
You said earlier that we had too much concentration in the Magnificent Seven, although I think we have to set aside Tesla and Apple, because Tesla's down something like 35% year to date. But obviously, we have seen huge gains in particularly those Fab Five, or whatever you want to call it. But then with the move by the Fed today, we did see regional banks advance more than 3%, and we saw the Russell 2000 up about 2%. Is this kind of a cue now for a further broadening in the market?
Very much potentially. I've been tracking quite I guess acutely the KRE ETF, which is a regional bank ETF, which came after obviously the calamity. It has rebounded quite sort of handsomely. Back to my earlier point about those undervalued stocks, I think they will play a part. They will be sector specific in terms of that broadening or widening of the market effect, but value can be had in some of those, I guess, sort of dumped stocks where the wider foundation of those particular sectors are still strong.
I'm not going to let you off the hook on the crypto stuff here. Give me 45 seconds. Your position on Bitcoin right now with a lot of volatility.
Yeah, exactly. Yeah, I think that's something that's very interesting. And what is it? Is it down to the mechanics of Bitcoin? Is it down to the upcoming halving? Is that going to play a part? Is it overbought? I guess is potentially one other question as well. I think that fund flow into the ETF space from an institutional standpoint has naturally driven, the price sort of higher. I think some profit taking in some of the equity markets and fund flow into Bitcoin is also helping it getting propped up. Where is the downside coming from? That's probably a very good question, gentlemen. That's a little bit one which probably needs a little bit more investigating. People are probably looking to get in and get out and take advantage, having had their fingers burnt in the previous sort of up cycle. So I think there's still more upside to be had in Bitcoin.
Yeah. Doug Oriano is saying that he thinks some money will flow out of equities and into crypto. And kind of what we've seen of late is both of them rallying at the same time. So only time will tell. Interesting to watch. Oriano, thanks very much for joining us. Oriano Lizza, CMC Markets Sales Trader, with us live here. 18 minutes past the hour. This is Bloomberg. Well, Tencent Holdings is planning to double its stock buyback program to nearly $13 billion. And joining us in our studios here in Hong Kong is the esteemed Vlad Savov, Bloomberg Tech editor. So let me see if I got this right. We had a miss on sales, but that was kind of offset by the buyback and raising the dividend. And we also had slightly better numbers. We had a beat on operating profit and net income. But somehow the miss on sales seems to be the biggest story. I mean, the stock is up, but that's probably because of the buyback. But there's something wrong here, Vlad. Is that right?
Yeah, absolutely. I mean, when you think about Tencent, it's such a vast company, but ultimately its core business is still domestic games within China. And that's been such a disrupted sector, and that's what Tencent is reflecting with its latest quarterly earnings. It's the lifeblood of the company still, much like the iPhone is for Apple. When I've watched Tencent with its quarterly earnings, I mean, it was delivering double-digit growth over the past 3 quarters. It's been one of the best operationally. But if you want to find fault, it is the fact that it hasn't internationalized its games business quite as much as others and investors might have hoped. And it hasn't diversified. So really the big takeaway from Tencent's earnings call last night is that discussion of how it's going to pursue high-quality growth. That was its tagline. It was repeated a dozen times. And how it's going to diversify away from that business, games in China, that is not growing as much as Tencent would like.
Where have I heard that phrase before? High-quality growth. Let me think. I'm just kidding.
Right from the top.
Yeah, right? But I'm wondering, to your point, if you can't really expand much outside the region, do you have to then drive business by creating a lot more in the way of new titles? Is that the strategy here? You just have to push out more product?
Right. Well, CSO James Mitchell, he said that they have 3 priorities. And the way that Tencent views the entire sector is, he said, we need to get our own house in order. And the 3 priorities are, you have these long-running, kind of everlasting titles like Peacekeeper Elite, which is a local version of PUBG Mobile. And what Tencent has done is put new leadership in place to revitalize monetization of those. Then you have the more recent titles, the ones that have just kind of picked up steam more recently, such as Fight for the Golden Spatula, whose name I love. They want to monetize that more aggressively. And then the third pillar of that is bringing in new titles, such as Dungeon and Fighter Mobile. They talk that up. They're moving up the release date for that to the 2nd quarter of this year, in China, that is, because that got approved by the Beijing government. And they said that they expect games revenue to pick up from the 2nd quarter as well.
Yeah, Bloomberg Intelligence analyst Robert Lee, who we've had on the program a lot, is reasonably positive on Tencent's prospects for this year, that they will deliver double-digit earnings growth in 2024. We've had a number of issues with slowness in the Chinese economy and also the regulatory overhang. Do either of those two look to be getting substantially better in the coming year?
Right. Well, this was an interesting thing. Tencent President Martin Lau, he said it during the earnings call. There was a question about the regulatory situation. If you recall, Brian, in December, there was an indication via a draft of new regulations about Beijing cracking down again on gaming that dragged down Tencent's share price significantly. Martin Lau's comment was really definitive about this. He said that's not a concern of ours. He said that in recent times, in recent weeks and months, the government has really signaled a much more supportive stance towards gaming. They've given much more licenses for new games. Effectively, I mean, he said if those draft regulations even come to pass. So it might not even happen, is his position. That's the view. And I would also say, you mentioned Rob Lee, he and I will have conversations about this, and I would be remiss not to mention the point that he makes, which is Tencent is not only moving toward quote-unquote high-quality growth, it's moving toward higher margin businesses, more fintech, more ads. It's a better way to monetize, and maybe it's also a more sustainable way in the long run.
So where does artificial intelligence enter into that conversation, if at all? Is it a part of the thinking here?
Yeah, Martin Lau said that at the moment and for the near term, it's going to bolster Tencent's ad the most. It's helping ad targeting, which I don't know how to feel about. I don't really want ads to target me that much better. But in the long run, AI generating content, it's also going to feed into the games pipeline. largely to create animated content. That's what Tencent said.
You remember in the past when we had PEs up around 50 or so for Tencent. Currently, forward PEs 14, trailing PE 22. Those days are gone, aren't they, though, with Tencent? Because it had revenues at those during those years growing 40-50% as well.
That's right. I mean, one way to think about this, my best analogy for Tencent is actually that it's kind of like an alcohol maker. There's a set base of people who will keep buying your product. Some of them are probably addicted. But the difference with Tencent, because it's in tech, because it's in AI, it has this upside, which is largely unpredictable, where it can strike gold. It can produce something like TikTok. Like I say, operationally, Tencent has shown itself to be really good. It's a vast company, and there's always a potential for the company to grow through that. But talking to our stocks colleague, they did say that the share price currently has like zero premium for the potential of AI within Tencent. So investors at least don't have the confidence that maybe I have.
Last question. I can only give you about 20 or 30 seconds to answer. Is the regulatory risk no longer a factor?
That's what Tencent says. I'm not sure that everybody believes the company.
All right, Vlad, thanks very much. I'm glad that Doug asked you about AI because AI doesn't come up that much with Tencent. And when I interviewed Rob, previewing the earnings, I didn't even ask him about AI, and he didn't even bring it up. So it is an interesting question, and it's one that there is some room there for Tencent. If it does manage to expand their Tencent analysis here from Vlad Savov, Bloomberg Tech editor.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.